New York housing does not usually drift into danger all at once, because it is not a market that moves quickly or cleanly or in straight lines, and that slowness has always been its greatest stabilizer and its greatest illusion at the same time, since what looks like resilience on the surface is often just pressure accumulating in places most people never look until something finally gives. For most of the past century, the city's housing system has survived depressions, wars, fiscal crises, waves of immigration, white flight, reinvestment, abandonment, and financialization, not because it avoided stress, but because stress was absorbed unevenly by tenants without leverage, by owners without capital, by neighborhoods without political voice, and by buildings that simply deteriorated quietly while the rest of the city convinced itself that high demand was the same thing as health. The modern version of this story really begins in the long shadow of the 1970s, when New York came close to bankruptcy and housing stock in large parts of the city became functionally worthless on paper, not because people did not need places to live, but because the costs of maintaining buildings exceeded the rent they were legally allowed to collect and the tax burdens they were required to pay. That era produced the regulatory and psychological DNA that still governs the city today. Strong tenant protections born from genuine fear of mass displacement, a political suspicion of landlords that was earned rather than invented, and a belief that the city could not rely on private markets alone to house its population without periodic intervention that bordered on emergency management. When the city recovered in the 1980s and 1990s, housing did not simply normalize, it bifurcated. Some neighborhoods became investment-grade assets again, first slowly and then all at once, while others remained zones of thin margins and deferred maintenance, kept afloat by subsidies, rent regulations, and a kind of moral bargain in which owners accepted limited upside in exchange for long-term stability. Rent stabilization, which was originally conceived as a temporary measure, hardened into a permanent structure not because it worked perfectly, but because removing it always seemed riskier than leaving it in place, especially in a city where displacement has never been an abstract concept, but a lived memory that cycles through generations. By the time the 2000s arrived, New York housing had become something like a split-screen economy. On one side were luxury condos, global capital, and a pricing logic that had more in common with art markets than with shelter. On the other side were rent-stabilized apartments, small landlords, and buildings whose financial models depended less on growth than on endurance. These two worlds interacted constantly but followed different rules, and the city's political system learned to manage the tension by treating them as morally and economically distinct, even when they shared the same block. The 2008 financial crisis tested this arrangement but did not break it. Prices fell, transactions froze, but rents mostly held, and the city emerged with its core assumptions intact. That demand would always come back, that New York was structurally undersupplied, that regulation could be tightened without fundamentally impairing the system, and that capital, while skittish, would ultimately return because there were few alternatives at this scale. In retrospect, this period reinforced a dangerous confidence that the housing market's worst outcomes were cyclical rather than structural, and that time itself was the ultimate shock absorber. The confidence set the stage for the 2019 rent law reforms, which were framed as a correction to years of aggressive rent hikes and speculative behavior in stabilized buildings, and which in many ways were exactly that. Vacancy decontrol was eliminated, rent increases tied to renovations were capped, and the path from regulated to market-rate rents was largely closed. For tenants, this brought predictability and security. For many owners, especially those who had bought buildings at prices that assumed future deregulation, it introduced a sudden mismatch between debt service and allowable income that could only be resolved through refinancing, capital infusions, or long-term erosion. What made this moment different from earlier regulatory shifts was not just the substance of the law but its timing. Interest rates were historically low, which softened the immediate impact by allowing owners to refinance at cheaper rates and extend maturities. Property values, at least on paper, did not collapse overnight because cap rates compressed and investors were willing to accept lower yields in exchange for perceived safety. The system absorbed the shock not by rebalancing, but by stretching itself thinner, betting implicitly that growth in other areas or future policy adjustments would eventually restore equilibrium. Then the pandemic arrived, and for the first time in decades, the assumption that demand in New York was effectively infinite was openly questioned. People left, offices emptied, rents fell sharply in some segments, and the city imposed eviction moratoria that were morally understandable and politically unavoidable, but financially devastating for owners who depended on rent to cover fixed costs. Once again, the system survived, but survival came through extraordinary measures that deferred rather than resolved underlying stress. Forbearance agreements, emergency aid, and a collective agreement not to fully mark losses while the crisis was still unfolding. When people returned and rents surged in 2021 and 2022, it felt to many like proof that the old assumptions still held. Demand was back, prices were rising, and New York had once again demonstrated its peculiar ability to rebound faster than expected. But the rebound was uneven in ways that mattered more than the headlines suggested. Market-rate rents exploded, especially in desirable neighborhoods, while regulated rents remained constrained by law. Operating costs, meanwhile, did not respect that distinction. Insurance premiums climbed, property taxes increased, energy costs rose, and labor became more expensive. Buildings that relied on modest annual rent increases to keep up with inflation found themselves falling behind in real terms. At the same time, the interest rate environment reversed with stunning speed. Loans that had been originated or refinanced at 2 or 3% suddenly faced rollover at rates that doubled or tripled debt service. For properties with strong cash flow growth, this was painful but manageable. For rent-stabilized buildings with capped income and rising expenses, it created a mathematical problem rather than a cyclical one. There was no combination of efficiency improvements or minor renovations that could close the gap, because the gap was structural, fixed or slowly growing revenue meeting rapidly adjusting costs of capital. This is the point at which New York housing begins to enter what can fairly be called a danger zone, not because collapse is imminent or because catastrophe is inevitable, but because the traditional mechanisms that have allowed stress to be absorbed quietly are starting to fail simultaneously. Small landlords who once relied on refinancing to reset their balance sheets find lenders less willing to underwrite deals that no longer pencil under conservative assumptions. Larger owners with diversified portfolios can cross-subsidize losses for a time, but even they must eventually answer to investors, regulators, or bondholders who are less sentimental about the social role of housing than city politicians might wish. Meanwhile, tenants experience this pressure not as an abstract financial imbalance, but as deteriorating living conditions, slower repairs, and a creeping sense that buildings are being managed to survive rather than to improve. Deferred maintenance, once a temporary tactic, risks becoming a permanent feature, especially in older housing stock where capital needs compound over time. The city, which relies on property taxes to fund services, faces the prospect of declining assessed values in precisely the segment of the market that houses a large share of its residents. What makes this moment particularly unstable is that no single actor has both the incentive and the ability to resolve the problem alone. The state controls rent law, the city controls zoning and taxation, lenders control capital, and owners control day-to-day management, but the system only functions when these interests align loosely enough to allow compromise. Right now, they do not. Political appetite for loosening rent regulations is minimal, fiscal capacity for large-scale subsidy is constrained, and private capital is increasingly wary of committing funds to assets whose returns are capped but whose risks are not. Historically, New York has escaped similar traps through growth: more people, higher incomes, more construction, and rising values that paper over inefficiencies. But growth itself has become harder. New construction faces zoning constraints, community opposition, and financing challenges, while population growth is slower and more volatile than it once was. The city is no longer the only place where ambitious people feel they must live. And while that does not mean demand will disappear, it does mean it cannot be taken for granted as a cure-all. The danger, then, is not a dramatic crash, but a slow degradation, a housing system that continues to function on paper while becoming less livable, less investable, and more brittle over time. These are the conditions under which small shocks can produce outsized consequences because there is no slack left to absorb them. When roofs leak, they are patched instead of replaced. When boilers fail, repairs are delayed. When owners default, buildings drift into limbo, owned by entities that neither live in them nor have the incentive to improve them. New York has been here before, though never in quite this configuration, and the lesson of those earlier periods is not that decline is inevitable, but that denial is costly. Housing systems do not announce their breaking points in advance. They simply stop working the way people expect them to, and by the time that shift is obvious, the options are fewer and more painful. Whether the city recognizes this moment as a danger zone or continues to treat it as a temporary imbalance will determine not just prices or profits, but the basic quality of life for millions of people who experience housing not as an asset class, but as the physical container of their daily lives. If Part 1 describes how New York housing arrived at its current edge, Part 2 is where the system's internal mechanics begin to strain in ways that are less visible to the public, but far more determinative of what happens next. Because housing crises in this city rarely begin with people leaving en masse or buildings collapsing outright, and instead start with spreadsheets that stop balancing and loans that quietly fail to refinance on terms anyone would have accepted even a few years earlier. The refinancing wall now facing large portions of the rent-stabilized housing stock is not a sudden phenomenon, but the delayed consequence of decisions made during an era when money was cheap and regulatory risk was underestimated or consciously ignored. Thousands of buildings changed hands between roughly 2013 and 2019 at prices that assumed some combination of rent growth, vacancy turnover, or legislative softening over time. And while not every buyer was reckless, the market as a whole priced in a future that no longer exists. When the 2019 reforms froze those assumptions in place, the market adjusted not by repricing assets downward, but by extending debt maturities, lowering interest rates, and accepting thinner cushions, effectively borrowing time rather than resolving the underlying mismatch. That strategy worked as long as interest rates remained near zero and lenders were willing to play along, which they were, partly because regulated New York housing had historically been a safe asset class, and partly because marking large losses would have forced uncomfortable questions about valuation, collateral, and risk models across the financial system. Multifamily loans, especially those tied to stabilized buildings, sat on the books of regional banks, insurance companies, and government-sponsored entities as low-drama instruments that rarely made headlines and almost never failed in spectacular fashion. What changed was not just the cost of money, but the entire posture of risk. As rates rose, lenders stopped asking whether a building could service debt under optimistic assumptions and began asking whether it could survive under pessimistic ones. For a stabilized property with limited income growth and rising operating expenses, that distinction is fatal. A loan that once underwrote comfortably at a debt service coverage ratio of 1.25 might now struggle to reach 1, even before accounting for reserves, capital expenditures, or the inevitable surprises that come with aging infrastructure. When refinancing fails, it does not immediately produce vacancy or visible decay. Instead, it produces limbo. Owners negotiate extensions, seek mezzanine financing, inject personal capital if they have it, or simply stop investing in the building beyond what is absolutely required to avoid violations. Lenders, for their part, are often reluctant to foreclose, especially on occupied multifamily properties, because taking title does not magically solve the cash flow problem and introduces reputational and political risk. The result is a growing inventory of buildings that are neither healthy nor distressed enough to force resolution, slowly accumulating deferred obligations in the background. This dynamic is particularly acute among so-called mid-size landlords, who own a handful to a few dozen buildings and lack both the scale of institutional players and the flexibility of owner-occupiers. These landlords often operate on thin margins, rely heavily on leverage, and have personal finances intertwined with their properties in ways that make walking away psychologically and practically difficult. They are also the least visible participants in housing policy debates, which tend to frame the market as a binary between vulnerable tenants and faceless corporations, even though a large share of stabilized housing sits in this middle tier. As stress accumulates, behavior changes in subtle but consequential ways. Maintenance shifts from preventative to reactive. Capital improvements are postponed indefinitely. Staffing is reduced, which means fewer superintendents, slower response times, and more reliance on temporary fixes. None of this registers as a crisis in isolation, but taken together, it alters the lived experience of housing in ways that are hard to reverse once they become normalized. Buildings age faster when they are managed defensively, and the cost of eventual repair rises exponentially. At the same time, municipal enforcement mechanisms strain under their own contradictions. The city can and does issue violations, mandate repairs, and levy fines, but these tools assume that non-compliance is a choice rather than a function of constrained capital. When owners genuinely cannot access financing on viable terms, enforcement becomes a circular process that generates paperwork rather than improvements. In extreme cases, buildings enter alternative management programs or public control, but these systems were never designed to absorb large volumes of properties simultaneously, nor do they address the systemic causes that push buildings into distress in the first place. The capital markets, which once provided a backstop, are increasingly selective. New equity is difficult to attract to stabilized housing because returns are capped, while regulatory risk remains high and asymmetric. Debt, where available, comes with stricter covenants, higher reserves, and shorter terms, all of which increase the likelihood of future distress rather than alleviating it. The old logic that low risk justified low return no longer holds when the definition of risk has expanded to include political and regulatory unpredictability that cannot be modeled away. What makes this especially dangerous is that the distress is concentrated in the segment of the housing stock that serves lower and middle-income tenants, precisely the population for whom alternatives are scarcest. Market-rate units can adjust through price, attracting or repelling demand as conditions change. Stabilized units cannot, which is their purpose, but that rigidity requires a counterbalancing source of support to keep the system functional. When that support is absent or insufficient, the rigidity becomes a point of failure rather than protection. The public sector is aware of these pressures, but constrained in its response. Large-scale subsidy programs are expensive and politically fraught, especially in a fiscal environment shaped by competing priorities and lingering pandemic-era deficits. Tax abatements and incentives can help at the margin, but do not solve the core issue of debt overhang and insufficient income growth. Moreover, any policy perceived as a bailout for landlords, regardless of its practical necessity, faces intense opposition in a city where housing politics are deeply moralized and historical grievances remain fresh. Meanwhile, tenants experience the system's stress through a growing sense of fragility. Leaks take longer to fix, heat outages become more frequent, renovations stall midway, communication with management becomes strained or opaque. These conditions do not always trigger immediate displacement, but they erode trust and quality of life, reinforcing the feeling that stability is provisional rather than secure. For long-term residents, especially those who lived through earlier cycles of decline, the signs are familiar enough to be unsettling, even when the broader market narrative remains upbeat. There is also a generational component that complicates resolution. Older owners who entered the market when prices and leverage were lower may be able to ride out the storm, while newer entrants face harsher arithmetic with less room for error. This creates an uneven landscape where some buildings remain well-maintained and others slip steadily backward, not because of differences in care or competence, but because of timing and capital structure. Over time, this unevenness reshapes neighborhoods in ways that are difficult to predict or plan for, undermining the very stability that rent regulation aims to preserve. Historically, New York has relied on a combination of benign neglect and selective intervention to manage such periods, allowing weaker properties to fail quietly while stronger ones absorb displaced demand. But that approach assumes there is sufficient slack in the system to accommodate failure without cascading effects. In a city already constrained by limited supply, high construction costs, and political resistance to new development, that slack is minimal. Each distressed building represents not just a financial problem, but a node of potential instability in a tightly coupled system. The danger zone, then, is defined less by any single metric than by the convergence of constraints. Income is capped, costs are rising, debt is repricing, capital is cautious, policy is rigid, enforcement is blunt. None of these elements alone would be fatal. Together, they form a system that has lost its capacity to self-correct. The longer this condition persists, the more likely it is that resolution will come not through gradual adjustment, but through crisis-driven intervention, when choices are narrower and trade-offs harsher. New York housing has always been political, but it has also always depended on a certain amount of financial realism to function. When realism is postponed for too long, the eventual reckoning tends to be more disruptive, not less. Whether the current moment becomes another chapter of managed adaptation or the prelude to a deeper breakdown depends on decisions that are being delayed even as the underlying math grows more unforgiving. If the first two parts trace the internal stresses of New York's housing system, the third is where those stresses collide with the city's political economy in ways that make resolution harder rather than easier. Because housing in New York is not governed by a single authority or a unified vision, but by overlapping jurisdictions, constituencies, and historical compromises that evolved for a different era and now resist adaptation even as conditions change. At the center of this collision is the mismatch between how housing scarcity is discussed and how it is actually produced. For more than a decade, the dominant explanation for New York's affordability problem has been insufficient supply, a diagnosis that is broadly correct but operationally incomplete, because it assumes that supply can be increased at scale within existing political and regulatory constraints. In practice, zoning limits, community opposition, environmental review, and infrastructure capacity combine to make large-scale new construction slow, expensive, and geographically uneven, concentrating growth in areas already experiencing pressure while leaving others largely untouched. This pattern reinforces a familiar cycle. Neighborhoods that accept or are targeted for development absorb disproportionate change, provoking backlash that hardens resistance elsewhere. Political leaders respond by downshifting ambition, trading comprehensive reform for incremental rezonings and negotiated projects that deliver units slowly and at high cost. Each deal is framed as progress, and in isolation it is, but collectively they fail to alter the system's trajectory, because the volume of new housing never approaches the level needed to meaningfully relieve pressure across the market. The problem is not merely procedural, but conceptual. Much of the city's housing policy discourse treats new construction and tenant protection as separate or even opposing goals, when in reality they are interdependent. Strong tenant protections increase the importance of new supply because they reduce turnover and price flexibility, while constrained supply increases the stakes of regulation because scarcity magnifies the value of protected units. When supply fails to materialize, regulation bears the weight of maintaining stability on its own, a role it was never designed to fulfill indefinitely. Demographic shifts complicate this further. New York's population is no longer growing in a simple upward line, but fluctuating in response to economic cycles, remote work, immigration policy, and cost of living pressures. This volatility undermines traditional planning assumptions, making it harder to justify long-term investments or to calibrate policy based on steady growth. At the same time, household formation patterns have changed, with more people living alone or delaying family formation, increasing demand for units even when population growth is modest. Construction costs amplify these challenges. Labor shortages, material price volatility, and regulatory requirements have pushed per-unit costs to levels that make purely private development feasible only at the high end of the market or with substantial subsidy. Affordable housing programs, while essential, are slow and capital-intensive, relying on complex financing stacks that take years to assemble and deliver units long after the conditions that justified them have shifted. The result is a system that responds to crisis with lag rather than anticipation. Meanwhile, political incentives favor visible action over structural reform. Tenant protections can be strengthened with a legislative vote and deliver immediate, tangible benefits to a large constituency. Zoning reform, by contrast, requires confronting entrenched interests, navigating procedural hurdles, and accepting change that may not produce results for a decade. In an environment of short electoral cycles and high housing anxiety, the former is far easier to pursue than the latter, even if the long-term consequences are counterproductive. This asymmetry feeds directly into the danger zone identified earlier. As regulation tightens and supply remains constrained, the economic burden of maintaining housing stability shifts increasingly onto the existing stock and its owners, without providing them with tools to adapt. The city effectively asks stabilized buildings to serve as permanent affordability infrastructure, while denying them access to the revenue growth or capital support such infrastructure requires. Over time, this transforms private housing into a quasi-public good without a corresponding public funding mechanism, a model that is inherently unstable. Neighborhood-level politics exacerbate the problem. Community boards and local elected officials wield significant influence over land use decisions, often prioritizing preservation of existing character over accommodation of growth. While these concerns are understandable, their cumulative effect is to freeze large portions of the city in time, pushing development pressure into a narrower set of corridors and districts. This not only inflates land prices in those areas, but also limits the geographic spread of new housing, reinforcing patterns of segregation and inequality that housing policy ostensibly seeks to dismantle. The limits of construction as a near-term solution become especially clear when viewed against the scale of existing need. Even an aggressive building program would take years to materially expand supply, during which time the stresses on the current housing stock would continue to intensify. For tenants in stabilized buildings, new construction offers little immediate relief, while for owners, it introduces competition without alleviating their financial constraints. The system thus experiences the worst of both worlds: long-term plans that do not address short-term deterioration. Immigration, historically a stabilizing force for New York housing demand, adds another layer of complexity. New arrivals tend to concentrate in more affordable segments of the market, increasing pressure on stabilized units even as political rhetoric emphasizes protection over expansion. Without sufficient new housing to absorb this demand, competition intensifies within the regulated system, raising the stakes of maintenance, management, and enforcement while deepening the consequences of failure. What emerges is a feedback loop in which political caution reinforces structural scarcity. Scarcity elevates the importance of regulation, regulation strains financial viability, and financial strain degrades housing quality. Each element strengthens the others, making it increasingly difficult to intervene at a single point without triggering unintended consequences elsewhere. The city's governance framework, built for incremental adjustment, struggles to respond to a problem that is systemic rather than episodic. Historically, moments like this have produced two types of outcomes in New York. In one, crisis forces alignment, leading to sweeping reforms that rebalance interests and reset expectations, often after significant pain. In the other, the system muddles through, absorbing damage unevenly while avoiding explicit reckoning, until conditions deteriorate enough to make emergency intervention unavoidable. Which path the city follows depends less on intent than on timing and the distribution of political costs. For now, the signs of stress remain diffuse enough to avoid galvanizing a unified response. There is no single collapse, no dramatic exodus, no visible abandonment on the scale of past crises. Instead, there is a quiet accumulation of small failures, projects that do not get built, buildings that do not get repaired, loans that do not get refinanced, policies that do not quite solve the problems they target. Individually, these are manageable. Collectively, they shift the system into a more fragile state. The danger zone, in this sense, is as much psychological as economic. It is the point at which assumptions about permanence begin to erode, when tenants no longer trust that protection guarantees quality, owners no longer trust that compliance guarantees viability, and policymakers no longer trust that incrementalism will buy time. Once that trust is lost, the system becomes more reactive, more polarized, and more prone to abrupt change driven by crisis rather than design. New York has avoided that tipping point before, often through a combination of growth, compromise, and selective amnesia about past mistakes. Whether those tools remain available is an open question. The constraints are tighter, the margins thinner, and the political landscape more fragmented than in previous cycles. What was once a resilient system now operates with little room for error, and in such conditions, even modest shocks can have lasting effects. When housing systems finally cross from strain into consequence, they rarely do so through a single dramatic failure, and New York is unlikely to be an exception, because the city's scale and complexity diffuse impact even as they magnify its reach. What emerges instead is a pattern of outcomes that appear disconnected at first glance, but share a common origin in the unresolved tensions that have been building for years. Buildings do not vanish, tenants are not immediately displaced en masse, and policymakers do not announce that a line has been crossed. The system simply begins to deliver less of what people expect from it, more slowly and less reliably, until that diminished baseline becomes the new normal. On the ground, this deterioration expresses itself through management rather than occupancy. Apartments remain occupied, leases remain in force, and legal protections remain intact, but the experience of living in the city changes in small, persistent ways. Repairs take longer not because of indifference, but because cash flow is constrained and contractors are harder to retain. Capital projects are deferred not once, but repeatedly, each delay compounding the next. Buildings that once felt stable begin to feel provisional, as though they are being kept functional rather than cared for, and that distinction matters more to residents than policymakers often acknowledge. For tenants, especially those in stabilized units, the bargain implicit in regulation begins to fray. Rent protection was never meant to guarantee luxury, but it did carry an expectation of habitability and continuity. When hallways deteriorate, common areas go unmaintained, and systems fail more frequently, tenants face a paradox. They are protected from displacement, but increasingly trapped in housing that declines around them. The legal mechanisms available to enforce standards exist, but they are slow, adversarial, and often ineffective when owners lack the resources to comply fully, turning enforcement into a process of attrition rather than resolution. For owners, the outcome is a form of slow insolvency that does not resemble bankruptcy in its formal sense, but erodes capacity over time. Equity evaporates not through a sudden drop in value, but through the accumulation of unaddressed liabilities and the inability to reinvest. Buildings become less liquid, less financeable, and less attractive to responsible buyers, increasing the likelihood that when transfers do occur, they are to actors willing to accept lower standards in exchange for survival. This dynamic has played out before in New York, producing cycles of ownership that prioritize extraction or endurance over stewardship. Lenders, confronted with portfolios that no longer behave as expected, adjust defensively. New lending becomes more conservative, appraisals more pessimistic, and workout strategies more prolonged. Rather than triggering widespread foreclosures, which would force losses into the open, lenders often choose to extend and pretend, maintaining the appearance of stability while the underlying assets weaken. This approach reduces short-term disruption but increases long-term fragility, as unresolved distress accumulates across multiple balance sheets simultaneously. The city itself absorbs these effects unevenly. Property tax revenues from stabilized buildings flatten or decline, even as demands on municipal services increase. Enforcement costs rise as more buildings fall into non-compliance, while the effectiveness of enforcement falls. Public trust erodes as residents encounter a growing gap between policy intent and lived reality. The city's ability to respond is constrained not just by budgetary limits, but by institutional inertia, as programs designed for episodic intervention strain under sustained demand. At a neighborhood level, these pressures produce subtle but lasting shifts. Blocks with higher concentrations of financially stressed buildings begin to lag behind in quality and upkeep, reinforcing patterns of inequality that housing policy was meant to counteract. Small businesses feel the effects as residents spend less locally and foot traffic declines. Schools, transit, and other services experience incremental strain, not because of sudden population loss, but because stability becomes more fragile and planning assumptions less reliable. The danger of this trajectory lies in its plausibility. None of these outcomes require dramatic policy failure or economic collapse. They are consistent with a system that continues to function, but at a lower level of effectiveness, normalized through repetition and fatigue. Over time, this normalization reduces the political urgency of intervention, even as the cost of meaningful repair rises. What could have been addressed through targeted adjustments begins to require systemic overhaul, a far more difficult proposition. There are, in theory, paths out of this condition. The state could recalibrate rent regulation to allow for limited, predictable income growth tied explicitly to maintenance and capital investment. The city could align zoning reform with infrastructure investment to unlock new supply in a way that is both faster and more evenly distributed. Public financing tools could be expanded to help recapitalize distressed buildings in exchange for enforceable standards and long-term affordability. None of these options are novel, and none are without trade-offs, but all require political alignment and a willingness to accept imperfection in pursuit of stability. What makes these paths uncertain is not a lack of technical solutions, but a lack of consensus on risk. Each proposal carries visible political costs and diffuse benefits, while inaction carries diffuse costs and delayed consequences. In such an environment, the rational strategy for individual actors is often to wait, even as waiting makes collective outcomes worse. The city has navigated similar stalemates before, but usually with more margin for error than exists today. If no meaningful intervention occurs, the most likely outcome is not collapse, but entrenchment. A housing system divided more sharply between new, expensive units and aging, regulated stock. A tenant population increasingly polarized between those with secure but deteriorating housing and those priced out entirely. An ownership class narrowed to those with either exceptional scale or exceptional tolerance for low returns and high friction. In this scenario, New York remains expensive, unequal, and functional enough to avoid crisis narratives, but less dynamic and less humane than its reputation suggests. Historically, New York's housing resilience has rested on its capacity to adapt without fully confronting its contradictions. That strategy may no longer be sufficient. The danger zone described here is defined by the erosion of buffers that once allowed compromise to emerge organically. Without those buffers, adaptation becomes more painful and more politicized, and the cost of delay rises with each passing year. The question, then, is not whether New York housing will change, but how and under what conditions. Change driven by design can be uneven but deliberate. Change driven by neglect is uneven and indifferent. The city's past suggests it is capable of choosing the former, but its present suggests it may drift toward the latter unless the warning signs are taken seriously. New York has always asked its housing system to carry more than its share of social responsibility, to absorb inequality, volatility, and political hesitation without breaking. For much of the last century, it managed to do so through a combination of growth, regulation, and improvisation. Whether that balance can be restored, or whether the system settles into a lower equilibrium that future generations accept as normal, will determine not just where people live, but how they live and how much faith they retain in the idea that the city works for them at all. That is the nature of the danger zone, not a moment of crisis, but a narrowing of possibility.